You know what's fascinating about market squeezes? They don't happen overnight. They build slowly, methodically, like pressure accumulating behind a dam. And right now, in the silver market, that dam is showing cracks that are impossible to ignore. Let me paint you a picture of what's actually happening right now in December 2024, because the data we're seeing is absolutely extraordinary. Silver just closed at levels we haven't witnessed in over a decade, and the mechanics behind this move are telling us something profound about what's coming next. Here's what caught my attention last week. The London Metal Exchange reported something unusual. Physical silver deliveries are being delayed, not by days, by weeks. And when I started digging into why, I discovered a story that's been building for months, hidden in plain sight while everyone was focused on gold. You see, silver has always been the volatile, younger sibling of gold. More industrial, more speculative, more prone to explosive moves. But what's happening right now is different. This isn't speculation driving the price. This is something far more fundamental and far more dangerous for anyone betting against this metal. Let me take you back to October 2024. Silver was trading around $28 an ounce. Respectable, but nothing extraordinary. Then something shifted. The COMEX reported a drawdown in registered silver inventories. Not a small one. We're talking about a 23% decline in just 6 weeks. That's roughly 40 million ounces that simply vanished from available supply. Now you might be thinking, okay, inventories fluctuate. That's normal market behavior. But here's where it gets interesting. At the exact same time those inventories were dropping, open interest in silver futures was climbing. Dramatically. We saw short positions accumulate to levels not seen since 2020. Someone, or more likely several large institutions, were making massive bets that silver was going to fall. They were wrong. And now they're trapped. Let me explain how a short squeeze actually works, because understanding the mechanics is crucial to seeing why this situation is so precarious. When you short a commodity, you're essentially borrowing it, selling it, and hoping to buy it back cheaper later. It works beautifully when prices fall. But when prices rise, you face a problem. You still have to deliver that physical metal. And if there isn't enough physical metal available, you're forced to buy at whatever price the market demands. That's the squeeze. And in silver right now, the physical market is tightening like a vice. Here's a number that should make you sit up and pay attention. Global silver mine production has been declining for 3 consecutive years. In 2024, we're on track to produce roughly 820 million ounces. That sounds like a lot until you realize that industrial demand alone is consuming over 600 million ounces. Solar panels, electronics, electric vehicles, medical equipment. Silver isn't just a monetary metal anymore. It's become absolutely critical to the green energy transition. And here's the kicker. Unlike gold, which gets recycled at rates above 90%, silver gets consumed. It's used in such small quantities in electronics that it's not economically viable to recover it. Once it goes into a solar panel or a circuit board, it's essentially gone from the supply chain forever. So, we have declining production, rising industrial consumption, and now, increasingly, we have investment demand coming back into the market. Silver ETFs saw inflows of over $200 million in November alone. That's physical silver being pulled off the market and locked away in vaults. Let me tell you a story about what happened in 1980, because there are eerie parallels to today. The Hunt brothers, Nelson and William, decided they were going to corner the silver market. They started accumulating physical silver and silver futures contracts. At one point, they controlled nearly half of the world's deliverable silver supply. The price went from $6 an ounce to $50 in just a few months. Now, I'm not suggesting we're going to see that kind of move. The market is different now, more regulated, more sophisticated. But the fundamental dynamic is similar. When physical supply gets tight and short positions are large, prices can move violently and unpredictably. And right now, the setup is remarkably similar to early 1980. Large, short positions, declining inventories, growing awareness among investors that something is wrong with the supply picture. Let me show you what the smart money is doing. Central banks, which traditionally focus on gold, have started adding silver to their reserves. Mexico, Peru, and India have all increased their silver holdings in 2024. These aren't speculative traders. These are institutions with 100-year time horizons making strategic decisions about monetary metals. Why would they do that? Because they understand something that most investors are just beginning to grasp. The dollar-based monetary system is under stress. Real interest rates, after accounting for inflation, are still negative in many parts of the world. And when paper currencies lose purchasing power, hard assets become increasingly attractive. But here's where silver has a unique advantage over gold. It's more affordable. A single ounce of gold costs over $2,000. An ounce of silver, around $32 as of this week. That accessibility matters. It means retail investors, ordinary people worried about inflation and currency debasement, can actually participate in the precious metals market without needing massive capital. And they are participating. Coin dealers across the United States are reporting shortages of silver eagles and silver rounds. Premiums over spot price have jumped from $3 an ounce to over $6 in some markets. That's a clear signal that physical demand is outstripping supply at the retail level. Now, let me address something important here, because if you're sitting on retirement savings, this matters to you. A lot of people don't realize you can actually hold physical precious metals inside a retirement account. It's called a gold IRA, though it can hold silver too. I put together a free guide explaining exactly how this works, how to move funds from existing retirement accounts without tax penalties, and what to look for in a custodian. If you've got $100,000 or more in retirement savings and you're concerned about currency debasement, it's worth checking out. Link is in the description. No obligation, just information. All right, back to the squeeze mechanics, because this is where it gets really interesting. The COMEX, which is the primary futures exchange for silver in the United States, operates on a fractional reserve system. For every ounce of physical silver in COMEX warehouses, there are roughly 120 ounces of paper claims. That works fine as long as most people are content to settle in cash rather than demanding physical delivery. But what happens when that changes? What happens when futures holders start standing for delivery, insisting on actual metal rather than cash settlement? We got a preview of this in March 2020. During the COVID panic, the spread between physical silver and paper silver blew out to unprecedented levels. Physical silver was trading at $18 an ounce, while futures contracts were settling at $12. That $6 spread represented a complete breakdown in the normal arbitrage mechanism that keeps these markets aligned. The COMEX had to change its delivery rules. They started accepting silver bars from London vaults, which have different specifications than COMEX bars, just to prevent a default. Think about that. The world's largest silver futures exchange came within days of being unable to deliver physical metal to contract holders. That was a warning shot, and the structural issues that caused that crisis haven't been resolved. If anything, they've gotten worse. Let me walk you through what's happening in the physical market right now, because the details matter. The London Bullion Market Association, which oversees the wholesale physical silver market, reported something unusual in their November data. The amount of silver in LBMA vaults dropped by 42 million ounces in a single month. Where did it go? Some went to India, which has been a voracious buyer of silver for jewelry and industrial use. Some went to China, which is stockpiling strategic metals as part of its long-term economic planning. And some simply went into private storage, wealthy individuals and family offices taking delivery and holding physical metal outside the banking system. This is what a supply squeeze looks like in its early stages. It's not dramatic. It's not a sudden price spike. It's a gradual, relentless tightening of available supply, while demand remains strong or grows. And here's what makes this particularly dangerous for short sellers. Silver has a relatively small market compared to other commodities. The entire above-ground supply of silver, all the silver that's ever been mined and is still in identifiable form, is worth maybe $60 billion at current prices. That's less than the market cap of many individual tech companies. What that means is that it doesn't take massive capital flows to move the silver market. A few $billion of buying pressure, sustained over weeks or months, can push prices significantly higher. And when prices start rising, short sellers face margin calls. They're forced to either put up more cash or close their positions by buying silver. which pushes prices higher, which triggers more margin calls. That's the feedback loop that creates a squeeze. And we're seeing the early signs of it right now. Let me give you some specific numbers from the latest Commitment of Traders report, which tracks positioning in futures markets. Commercial traders, which are typically the large banks and trading houses, are short roughly 250 million ounces of silver. That's about 30% of annual global production. And their short position has been growing even as prices have been rising. That's unusual. Normally, when prices rise, shorts start covering, reducing their positions to limit losses. But these shorts have been adding to their positions, apparently convinced that silver is overvalued and due for a correction. They might be right. Markets can stay irrational longer than you can stay solvent, as the saying goes. But the physical fundamentals suggest they're fighting a losing battle. Here's why. Solar panel installations are projected to grow by 40% in 2025. Each gigawatt of solar capacity requires roughly 30 tons of silver. We're talking about an additional 60 million ounces of silver demand just from solar, on top of existing industrial consumption. Electric vehicles are another growing source of demand. The average EV uses about 1 ounce of silver in its electrical systems. With EV sales projected to reach 20 million units in 2025, that's another 20 million ounces of demand. And then there's the monetary demand. As I mentioned earlier, central banks are diversifying into silver. But it's not just central banks. Sovereign wealth funds, pension funds, and endowments are all increasing their allocations to real assets as a hedge against currency debasement and geopolitical instability. Add it all up, and you're looking at a structural deficit in the silver market. More silver is being consumed than is being produced. And that deficit is being filled by drawing down above-ground inventories. How long can that continue? That's the trillion-dollar question. Or in this case, the $60 billion question. Let me tell you about what happened in 2011, because it offers some clues about how this might play out. Silver started that year around $30 an ounce. By April, it had rocketed to $49, a 63% gain in 4 months. What drove that move? A combination of factors. Quantitative easing by the Federal Reserve was debasing the dollar. The European debt crisis was creating uncertainty about fiat currencies, and investors were piling into precious metals as a safe haven. But here's what's different about today. In 2011, silver mine production was growing. New mines were coming online. Supply was increasing to meet demand. Today, mine production is declining. The easy-to-extract silver has already been mined. What's left requires more energy, more capital, and more time to bring to market. And energy costs are rising. Mining is an energy-intensive business. When oil and electricity prices go up, mining costs go up. That puts a floor under silver prices. Below a certain level, it's simply not economical to mine silver. Most analysts estimate that all-in sustaining cost for silver mining is somewhere between $20 and $25 an ounce. With silver currently trading around $32, miners are profitable, but not wildly so. There's not a lot of incentive to dramatically increase production, even if they could. So we have a situation where supply is constrained, demand is growing, and prices are being held down by large, short positions in the futures market. Something has to give. Let me paint a scenario for you. Imagine a large industrial consumer of silver, maybe a solar panel manufacturer or an electronics company, decides they need to secure their silver supply for the next year. They go to the physical market and try to buy, say, 10 million ounces. In a normal market, that's not a problem. Dealers would source the metal from various suppliers, maybe pay a small premium, and deliver it over a few weeks. But what if the physical market is already tight? What if dealers don't have 10 million ounces readily available? They'd have to go to the futures market, buy contracts, and stand for delivery, which means taking metal out of COMEX warehouses. Now multiply that by several large industrial consumers all trying to secure supply at the same time. Suddenly, you have a run on physical silver. COMEX inventories, which are already at multi-year lows, get depleted further. And the shorts, who were counting on being able to deliver paper contracts without having to source physical metal, find themselves in a bind. They have two choices: default on their contracts, which would be catastrophic for the integrity of the futures market, or buy physical silver at whatever price necessary to make delivery. That's how squeezes happen, not through speculation, but through the cold, hard reality of physical supply and demand. And here's the thing, the people who are short silver right now, the big banks and trading houses, they know this. They're not stupid. They understand the risks, but they're also trapped. They can't just close out 250 million ounces of short positions without moving the market against themselves. They're hoping, praying, that something changes, that industrial demand softens, that mine production increases, that investment demand fades. But what if none of those things happen? What if demand continues to grow while supply remains constrained? Then we're looking at a squeeze that could make 2011 look tame by comparison. Let me give you some historical context because silver has a long history of explosive moves. In 1979, silver was trading at $6 an ounce. By January 1980, it hit $50, an 800% gain in less than a year. In 2008, silver bottomed at $9 during the financial crisis. By April 2011, it was at $49, a 440% gain in less than 3 years. These weren't gradual, steady increases. They were violent, parabolic moves, driven by a combination of monetary instability, supply constraints, and short covering. Could we see something similar in 2025? The setup is certainly there. Monetary policy is still accommodative despite recent rate hikes. Geopolitical tensions are elevated. The dollar's role as the global reserve currency is being questioned. And the physical silver market is tighter than it's been in years. I'm not making a prediction here. Markets are unpredictable. And anyone who tells you they know exactly what's going to happen is either lying or delusional. But I am saying that the risk-reward for silver right now looks compelling, especially if you believe that the structural issues in the global monetary system are far from resolved. Let me talk about what the technical charts are showing, because they're adding another layer to this story. Silver recently broke through a key resistance level at $30 an ounce. That level had capped prices for most of 2023 and early 2024. Breaking through it on strong volume is a bullish signal. The next major resistance level is around $35. If silver can break through that, there's not much overhead resistance until you get to the 2011 highs around $49. And here's what's interesting about the chart pattern. We're seeing what technical analysts call a cup and handle formation. It's a bullish continuation pattern that often precedes significant upward moves. The cup was the decline from the 2011 highs down to the 2020 lows and the subsequent recovery. The handle is the consolidation we've seen over the past year. If this pattern plays out as it typically does, the measured move would take silver well above $50. Again, I'm not predicting that will happen, but the technical setup is consistent with a major move higher. Now, let's talk about what could go wrong with this thesis because it's important to consider the bear case. The biggest risk to silver is a strong dollar. Silver is priced in dollars, so when the dollar strengthens, silver typically weakens. If the Federal Reserve were to dramatically tighten monetary policy, pushing real interest rates significantly positive, that could put downward pressure on silver. But here's the problem with that scenario. The U.S. government is running trillion-dollar deficits. The national debt is over $34 trillion. Servicing that debt at higher interest rates becomes increasingly difficult. At some point, the Fed will be forced to choose between fighting inflation and preventing a debt crisis. History suggests they'll choose to prevent the debt crisis, which means keeping rates lower than inflation would otherwise dictate. And that's bullish for silver. Another risk is a collapse in industrial demand. If the global economy enters a severe recession, demand for silver in electronics, solar panels, and other industrial applications could decline. That would ease the supply squeeze and potentially lead to lower prices. But even in that scenario, monetary demand for silver would likely increase. During times of economic stress, investors flock to safe haven assets. We saw this in 2008 and again in 2020. Silver initially sold off as investors liquidated everything to raise cash, but then it rallied strongly as monetary stimulus kicked in and people sought protection from currency debasement. So while a recession would create short-term volatility, it might actually accelerate the longer-term bull case for silver. Let me bring this back to what's happening right now, today, in the silver market. Because while we can talk about historical parallels and future scenarios, what matters most is the current reality. The current reality is that physical silver is getting harder to source. Delivery times are extending, premiums are rising, and short positions remain stubbornly large despite prices moving higher. That's not a stable situation. It's a powder keg waiting for a spark. What could that spark be? It could be a large industrial buyer deciding to secure a year's worth of supply. It could be a sovereign wealth fund announcing a major allocation to silver. It could be a change in COMEX delivery rules that forces shorts to source physical metal. It could be a geopolitical event that drives safe haven demand. Or it could be something we haven't even thought of yet. Markets have a way of surprising us. But here's what I know with certainty. The fundamentals of the silver market have never been more bullish. Declining production, rising industrial demand, growing monetary demand, tight physical supply, large short positions. Every single one of those factors is pointing in the same direction. Higher prices. The only question is timing. And that's the one thing nobody can predict with certainty. What I can tell you is that the shorts are running out of time. Every day that passes with prices above $30 is another day of losses for them. Every ounce of silver that gets delivered out of COMEX warehouses is one less ounce available to cover their positions. Every new solar panel installation is another source of demand that can't be easily reduced. The pressure is building, and at some point, something is going to break. When it does, the move in silver could be spectacular. Not because of speculation or manipulation, but because of the simple, inexorable logic of supply and demand. This is the final warning to shorts. The market is telling you, in the clearest possible terms, that you're on the wrong side of this trade. Physical supply is tightening, demand is growing, and the longer you wait to cover, the more expensive it's going to be. For everyone else, for investors who understand that precious metals play a crucial role in a diversified portfolio, this is an opportunity, not to speculate, not to gamble, but to position yourself ahead of what could be one of the most significant moves in the silver market in decades. The dam is cracking. The pressure is building. And when it breaks, you want to be on the right side of that trade.